Welcome to the Airmere Roundtable. Today is the 1st of May, 2019, and I have my friend and guest, Steve Lentz. Hi, Steve. Nice to have you back.
Tom, thanks so much. Glad to be here.
Always a pleasure. And before we get too far into it, our normal disclosure that Airmere is not a broker-dealer or an investment advisor. This is for educational purposes only. Options and futures involve risks and are not suitable for all investors. Past performance is not indicative of future results, and if you'd like to read the whole disclosure, pause the recording or go to the bottom of any of our web pages.
Folks, like Tom said, I'm Steve Lentz with Volatility Timer, and everything we're going to talk about today is not meant to be personalized financial advice, of course, and we all know that options trading involves significant risk, and you should fully understand that before trading. Today, I want to go over one of the reports that we produce every day called the Market Probability Report. I'm going to explain the report, and then we're going to look at what it looked like as of yesterday's close. Okay, so we come out with 3 different reports every day. The Condor Butterfly Timing Report. I've done a couple sessions along those lines here at Airmere. And then the Bull Put Spread Report has a similar technology. And then the Probability Report is a bit different here. The website is volatilitytimer.com. We have a 10% off for all Airmere members. You could see the code down there. Just type that in and you're good to go. So let's go to the Probability Report. And here's the premise. And really, all 3 of my reports are meant to be supplements, timing supplements for those trading any kind of condor or butterfly strategy. Even if you lean bullish using broken wing butterflies and you want to lean those bullish, then the Bull Put Spread Report might be good. But they're meant to assist those trading these strategies. And I'm not really at all, concerning myself with the adjustment approach, the particular, the exact getting in the weeds on setting up the positions themselves, because there are so many ways of doing it, and Airmere covers a lot of good ones, excellent ones, in fact, pertaining to these premium selling strategies. I deal only with the SPX, but I'm concerned more with particularly the timing. Is today a good day to put on a condor or butterfly? Well, that would be the first report on the left. Is today a good day to put on a bull put spread or a bullish broken wing? Well, that would be the Bull Put Spread Report. The Market Probability Report answers this question. Based upon past occurrences of our current market condition today, how is the market likely to behave over the next 5, 10, or 15 days in terms of price and volatility? And so it's this report really is meant to assist those that have a more discretionary approach. If it shows that the market is likely to go up, well, you may want to adjust your adjustment strategy accordingly. If it's showing that there's some serious downside potential based upon the past, well, you might want to be a little bit firmer on your toes in case, getting ready for that market to blast downward, right? So keep that in mind. That's the purpose of the report that we come out with each day. Here's what a report looks like. I'm going to go over each section of this, and let's see, what do we begin with? And let's just go back to the statement itself, and we're going to build ourselves up to understanding this report in great detail, because I think if you have any kind of discretionary portion of your trading approach, then this thing can greatly assist you in determining when to make adjustments more with greater information, more information for you to factor in the probabilities. The first part of the statement states, based upon past occurrences of our current market conditions. So what we're going to do is look at the current market condition and define it, and then go back in time and see how often in the past it has occurred. Okay, so let's do that. How do I define current market condition? And I've been in this for 20 years. I've read years of stocks and commodity magazines, tons of textbooks on technical analysis, the shooting match, So if you had to define the current market condition, This is as good a way as any that I've come up with to define what's going on if you're going to predict 5, 10, or 15 days in the future. It's tough to take today's market condition and broadcast out 1 year, okay? Just doesn't work that well. So let's come here and we look at 3 different perspectives. Simple moving average to determine trend. Real simple. We take a 50-day simple moving average. Sometimes I'll vary it up a little bit, but not often. I just standardize it to 50. I look at the 2-day price action, whether it's an upswing with a higher high and higher low, downswing with a lower high and lower low, inside bar or an outside bar. Real simple. So typically you're going to have an upswing and then another upswing, or maybe an upswing then a downswing. Occasionally you'll get inside bars, you know, where all the action took place inside the previous bar, and occasionally you'll get outside bars where the action encompassed the previous day's high-low range. Occasionally then, like with yesterday's close, we'll use a close-to-close relationship if it really is super important in capturing what the market environment truly is, okay? Besides that, we look at the stochastic position. And what that means is we're basically looking at today's close in relation to the range over the last, say, 15 days, 3 weeks. All right, and then we smooth those and everything and apply a trigger line. But it makes a bit of a difference. You know, if you have 2 consecutive upswings, you know, knocking on the door of the 3-week range at the very top, that's a lot different of an environment than if you have 2 consecutive upswings that began at the very bottom of the 3-week range. Far different environments. So we want to capture the environment in total. And all that can make a difference if you're above the 50-day or below the 50-day average, right? So these 3 perspectives give us a 3-dimensional view that I think is about as good as any 3 aspects that you could choose to define and give us a picture of the current market condition. So once that's defined, and here I'm pulling an example back from December 13th, where we're clearly below the 50-day simple. If you look carefully, we have an upswing and then a downswing. Okay, you can see the current day in red is a downswing bar. The previous day was an upswing with a higher high and higher low. Okay, so that price action took place below the 50-day simple moving average. And in terms of the stochastic, if you look back at the 3-week range, okay, we're definitely underneath the halfway mark. We're underneath 50. So we're operating between 10 and 50, and our close is just barely above the 3-day average, the 3-day average there, okay? So all together, this gives us a perspective of what the current market condition is. We're going to take that market condition, we paint the bar red, and I put a little green circle above it. So now when I back out of my Metastock charting program, I'm able to then see how many times this current market condition has occurred in the past. Okay. Now remember, why are we even doing this? Well, we want to go back in the past and look and see what happened with each of these green bars, and on average, we want to see on average what actually happened. Was there a bullish bias or a bearish bias? Did the market explode in volatility or contract? Okay, now those are the questions we want to know so that we can make better decisions when it comes time to adjust condors and butterflies and bull put spreads. So that's what we're going to do now. Now that we've defined our current market condition, we're going to look at how the market behaved then and try and extract that in terms of price and volatility. How is the market likely to behave based upon the past over the next 5, 10, and 15 days? So now we go to the report, and I'm going to shoot over to the right side first and kind of zoom in on that a little. What's my next slide? Here we go. And so what we have here, now let me get my mouse going. You can see my arrow there. So let's just start at the top. This is for December 13th. And the baseline, you know, back then, the SPX had experienced 4,760 closes since January of 2000. So that's kind of our baseline population. There's 4,760 closes. Okay. Now, separate from that is our current market condition. We have had 78 situations which matched our current market condition there. Our current market condition occurred 78 times since Jan of 2000. That represents 1.6% of the total population. Now we're going to divide this up into two parts because we really want to have a bead the next day on what the market is likely to do in the next 5, 10, and 15 days, right? So we divide this up here. There were 28 times where the market the next day went above that current conditions high. So here we are, you get the report at night, and we know that if the market goes up and above that previous day's high, that's occurred 28 times in the past. We're going to look at what the market did in those situations. In this situation, the market went down below the previous day's close, previous day's low, 45 times. The rest of the time, I think we must have had inside bars because neither one of them got taken out. I think that happened probably 5 times, that there was an inside bar and neither the high or the low was exceeded the next day. Okay, so this is at the very edge of the report on the far right side. Now, let's go over to the left, and we're going to look at what we call rate of change. We're going to look for direction now. We're going to go back at those 78 occurrences and look at direction. And what we do is look at rate of change, and in my Metastock program, here's the definition. You can express it in terms of a percent or points. I always choose percent. And basically what we're doing is looking, and in Metastock, it's going to basically take a bar and tell you how far the close is moved from 5 bars ago. Here it's clearly come down, right? It's clearly come down, and that's why here the rate of change is at -1.5% or so right there. That's what you see. But we're looking at forward rate of change. I'm more concerned with what the market does after this bar comes out. I want to go back in the past and observe what the market did moving forward. And so when I do that, I just adjust this. I go forward 5 bars. I see previously that it moved up about 1% from here to there. And then I just log down here what the 5-day rate of change is for this bar. And this is the value I'm looking at. So when we say rate of change, we're looking at the forward rate of change, the average forward rate of change from any bar moving forward. Okay, just want to make that clear. Out of the 4,760 occurrence, or excuse me, out of all the closes of the SPX since Jan of 2000, here's the baseline. On average, one close to 5 closes later, the market went up on average roughly just almost 0.1% that you see there, 0.09. That's the baseline. Okay, it went up over 10 days, almost 0.2%. And over 3 weeks, on average, the SPX has gone up just a bit over 0.25% on average. Clearly, we've had more bull markets than bear during that time. The market has definitely gone up, and this is on average what you see. So that's the benchmark out of all the closes. Now we go to our 78 occurrences of our current market condition. Look at this. On average, the market went down over 5 days over 1/3% to the downside. Okay, almost about 2/3% over 2 weeks. And strangely, look at this. It recovers over a 3-week period of time on average. It appears to go down 2/3% and then up to being down 0.5% over those 78 occurrences that you see that we logged here. So clearly there's a bearish bias on average. Okay, so that's kind of good to know. If you're trading these positions, you kind of have some probabilities in mind here, what the likelihood is given a situation. Now, what's important here is we want to know the difference, because this is going to help us back into to ascertain whether that 0.36, is that 1/3 to the downside? Is that significant statistically? All right. Is this 2/3 statistically significant? Okay. I mean, you might think it is, but we're going to really define it in terms of what we call a z-score. But to get a z-score, we have to define the difference between the baseline, because the market has been moving up. In our market situations, it moves down. That's a difference of almost 0.5% there. 2 weeks, it's a difference of about, not quite a full percent. And then about 0.75% over 3 weeks to the downside. That's the difference. All right, now let's carve it up between the other, whether it exceeds the high on the bullish side. Look at that. If the market, for the 28 times that it went above the high, it actually, over 5 days, went up 1%. Look at that. That's outstanding. And then 2 weeks, it went up 0.71. And then, so it gradually went down the further out in time you went on average. Very interesting. That's something. Now, that's if it exceeds. Now, what's the difference here? It's a full 1% to the upside, 0.5%, about 1/3% to the upside. So if the market exceeds the high, you're looking at some strong differences to the upside. The 45 times it went below the low, you have some pretty strong differences here. Okay, a full percent, 1.5 over 1.5%, and well over 1% to the downside. Now, are these a big deal or not? All right, how statistically significant are these? And that's what we do, is we now look at the significance. And in the world of statistics, there's something called a z-score. And what it requires that we know is the difference between the baseline and what our little sample did. And then what we're going to do is divide that into the standard deviation. Okay, the standard deviation. Now, what is the standard deviation? Okay, now this is a real, I'm summarizing a lot here because I've done whole presentations on a standard deviation, but basically it's the smoothed average of the distances between today's moving average, either our 5, 10, or 15-day moving average, and the closes for each day contributing to that moving average. All right, and that's a mouthful. And especially when we have the word smoothed, there's a lot going into just that term itself. There's square roots and all this, and it's an ingenious way of coming up with something other than just the average itself, because there's flaws in just taking the average of the distances. You want to do the smoothing part of it, but I'm not going to dive into the weeds there on that smoothing process. I have before, and it's something worthwhile to understand. But we get a standard deviation here, which over a 5-day, the standard deviation is over 0.75%. All right, the 10-day, the standard deviation is over a full percent. And then the 3-week standard deviation is over 1 1/3%. So with that in mind, we now take these differences, okay, and divide it by the standard deviation. So what we get is called a z-score. And the z-score is basically telling you a percentage of a standard deviation that difference represents. Now, this is where the rubber meets the road, okay? Because we're looking at z-scores here. And if you have a z-score over 1.0 to the upside, that's a full standard deviation to the upside. This is about 1 1/4 standard deviation to the upside. That's a strong bullish bias for the 5 days. If it goes below the low, then you have a z-score of 1.25% to the downside. The 2-week z-score is almost 1.5 standard deviations to the downside. Strong bearishness here. So if you're trading your road trip and you're going to employ some discretionary aspects to your adjustment process, this is information that you might want to know going into the open. If you have some strong z-scores in either direction like this, that would be something that you might want to factor in to your decision as to when and how you're going to roll that thing or make your adjustments. Okay. I also throw in the report realized volatility, just to know how volatile the market is in each of these scenarios. Up at the top, the benchmark volatility. The SPX typically has a historical volatility. Others call it statistical. Like at Option View, that's what we always call it, statistical volatility. And then I think another appropriate term is realized volatility. What actually happens? Okay, that really separates it from implied volatility in a better way. Realized looks in the past. So the SPX basically averages between 15 and 16% on average, since we started looking at this Jan of 2000. Okay, in our current market condition, on average, we had realized volatility in the low 20s. If the market went up above the high, now we were well under 20. If it went below the low, well, then that was the bearish aspect we saw, and now we're in the high 20s. Big difference in volatility here that you can see. And again, these are on average. It's not guaranteed it's going to. We're just looking at the probabilities, right? We're just factoring in the probabilities in our decision making. So we're back to the report. This is what it looks like each day. And I also throw in the summary of what the market condition is. But I'll tell you what, let's look at last night's. And then this is about it. I know, Tom, I'm going much faster this time.
That's okay.
But let's look at last night's. And as of last night, you can see that on Monday, we had an upswing, a higher high and a higher low. Then yesterday, we had a downswing with a lower high and a lower low. We're above the 50-day moving average. In terms of stochastic, you could see we are very high here. This close is almost at the top of the 3-week range. See that? That's why we're up, around 95, pushing 95. Look at that. I mean, actually, it's right there when you pencil it out because it's factoring in today's number. But yeah, we're over 95 there, and that's even smooth. And so we're definitely trending up above 95. We had this price action. Now, here's what's kind of interesting, too. Look at the close. We had a downswing, yet the close is higher than the previous day's close. See that? See, if you have a downswing, typically you're going to have the close lower than the previous day's close. That market condition is going to be far more numerous, I think, in the past than having this unusual situation where you have a downswing with the close above the previous day's close. And that makes it kind of different. That's why we didn't have a whole lot of incidences of this happen. It's a very unique condition. In fact, it only occurred, look at this. Now, why is this? I do not have, interesting, there must be some outside bars here. This market condition occurred only 25 times since January of 2000. Very unusual. If I had left out that little close part, then the close-to-close relationship, then this number would have been in the hundreds probably, because to be in this situation with an upswing and a downswing, that happens a lot. But now that we threw in the close-to-close relationship, only happened 25 times in the past. So that means that the results a bit more volatile because there's not as big of a sample here, right? So keep that in mind. 19 times that the market went above the high the next day, like it did today, this morning. I think it gapped, if I'm not mistaken. and then only 8 times to the downside. So let's go take a peek here. And folks, when I look at this report, I just go straight to the z-scores. That's telling me the percentage of a standard deviation that we're looking at. And then if it's over a half a standard deviation in any direction, I'm going to get excited and really factor it in. But look what we got here. Baseline here, not even a half a standard deviation. However, going into today, you could see that the 5-day z-score was almost a 0.5% to the upside. And over the 2 and 3 week period, no real decision-making input there. But in the short term, yeah, just a little bit, almost bumping up on a half a standard deviation. But look, if it had gone down, I have 8 incidences where it did below yesterday's low. You could see the z-scores are huge on the downside, right? And so then you want to be on your toes. Look at that, 2 standard deviations over 2 weeks. You know, almost that for 3 weeks, 1.5, a little over 1.5 for the 5 days. So, you know, this was good information, I think, going into today's open. It went up. So now we're looking at, you know, a bullish bias. However, you get 2 and 3 weeks out, it dissipates real fast here. Okay. And that's it, Tom. Just a summary of my reports. This was the market probability report. And of course, 10% off for everybody that signs up.
So how would people get the 10%?
Oh, when you go to order, and each report is $125 a month, you get 7-day free trial. You have a coupon code you can pop in, and you'll get that percent taken off, 10%
I see
off.
the Aramir 10 code.
Right, exactly.
Okay.
Aramir 10. Just put it in the coupon code portion at the checkout counter, on the online checkout.
Okay, I don't see any questions. How have you been trading and using those reports to modify how you trade?
Yeah, exactly. But it's for the discretionary. And honestly, Tom, I'm a pretty systematic guy, but I do look at it and it helps. But all my testing, I typically have hard and fast rules to start with, and then this will lean me off of those as we go forward. And, you know, I have my own, you know, and I don't really teach it much at all anymore, but the broken wing butterfly approach and then the hedged bull put spread approach. But this is just a day-to-day way to come off the rules when you see something harsh coming at you, like what we just saw. If today had gone down below yesterday's low, I think that would be, you know, the ears should perk up.
Right. Well, it's an awfully strong market.
Yes.
I have a feeling that we're going to get close to 3,000 before we have any significant reversal. But, you know, you got to trade what's in front of you every day, right?
Well, look at this. I mean, you're seeing market climb, pull back, climb, pull back. It's fairly consistent.
It is.
You know, and
every time the market sells off from some news, the buyers step in and bring it right back.
Right. And all we could do is respond, but I don't know. I think, and I'd be curious to run. I mean, I've done everything. You know, I'm always curious about using point and figure analysis where you can actually chart targets and then pick the long range high and low from a given congestion range and all that fun stuff. There's so much out there to try and pinpoint those you know, what was another one? Andrew's pitchforks.
All right.
I've gotten Andrew pitchforks.
I haven't seen those for a while.
Oh, I know. But there's people that trade those things.
Yeah, well, I mean, there's a lot of different things you can use and a lot of market participants, and, you know, there's something for everybody.
Well, and Fibonacci expansion levels, those are always
Those are very popular, yeah.
Yeah, but you got the key is finding the first 2 points that you're going to use. Then you expand off of those, and you know, if you give 5 people the task of finding the likely expansion levels, they'll probably use 5 different points to begin with, you know.
Yep. That's true.
That's the tough part about that.
So Steve, how are you? Do you have a roadmap of things you want to add to the report or new reports?
I have thought about this. This is going to take a lot of work. Get your input on here. I think it would be interesting to see what the VIX was in the past, on average, at the baseline up at the top, but to have a whole nother separate coded or color-coded set of columns for just what the VIX did under our current market condition. In other words, did the VIX go up or down, in the past under our current market condition? What was it in our, in the past? I'm just curious as to whether that would be helpful or not.
It might be. I like to look at the VIX term structure, so the percent contango.
Yeah. So I'm thinking.
Like if you look at VIX Central, they plot that.
Is that predictive though, or is it coincidental?
Well, I'll tell you, when the market was going in and out of backwardation in early October, I closed half of my butterflies, my bearish butterflies, my road trips.
Yeah.
And then a couple hours later, the futures went into serious backwardation, and I put on lots of hedges on the downside. So that next day we had a 110-point drop, and I was still flat. But that is a great early warning sign that things are getting ugly, and you probably ought to attend to your downside risk.
Well, and there's some advisories out there for the, using the VXX,
right? Yep.
And just trading those ETFs based upon the backwardization levels.
Yeah, that's another good volatility product.
But I mean, you and I both know a couple people that are running those advisories, and looking at that, the relationship. And I tried doing a little, months ago, I tried looking at the long-term VIX versus the short-term VIX, because there's a 9-day VIX that the SIBO publishes, right?
Right.
So theoretically, you could take that 9-day VIX, look at the 30-day VIX, and look at that separation, and you're pretty much coming up with the same concept, if I'm not mistaken.
Yeah, I mean, I would bet that the futures, when they go into backwardation, would also be reflected on the VIX, the short term and the longer term.
Yes, exactly. So you can take that 9-day VIX and then the 30-day VIX, plot the difference, and then start seeing, just go to town, looking if there's any predictability there. And here's the beautiful part about the technology I have here in front of us. I can take any market condition. I don't have to just use the current market condition. I have this engine. I can plug any market condition in, and it's going to give me the Z-scores in terms of direction, up, down, and if it exceeds the previous day's high or low. And so I can say, show me all the times where backwardization was at a 20-day high or low,
right?
Something like that, and then ascertain whether it was predictive of future market direction. And I would just look at the Z-scores in that particular situation. I did run a study once, but this was months ago, and it's just getting out enough time that I forgot exactly what the conclusions were, but maybe that's a topic for another presentation if we go down that rabbit hole. It's a world of wonder when you start diving into derivatives of derivatives of derivatives,
right?
And it starts to mess with your mind after a while, I think. But that's just me. It certainly is fun.
Well, sure, a nice robust platform you've set up and put together, Steve.
Well, thanks. It's a lot of fun, and I can do more research on this. Yeah, if you have any ideas along those lines, I can maybe run it through, and I'll come back and show you the results.
So if people wanted to send some ideas to you, what would be the best way to contact you?
Yeah, Steve at
Just
volatilitytimer.com, bottom left corner there.
there. That's what I thought, but I just wanted to make sure.
Yep, Steve, you can just email me. And maybe my next presentation, Tom, if it'd be okay, I'd come back with some results of a few studies like that. Might
Oh,
be some
sure.
fun. You can shoot me an email, and we'll settle in on something for me to test. That
Sounds
would
good.
be I'd be honored. That would be great.
All right. Well, no questions still, so I think we no need to keep everybody here.
Okay,
I really appreciate you coming on, Steve, and sharing, and I'm sure we'll have you back on in the future.
excellent. I look forward to it, Tom. Thanks so much, everyone.
All right. Thanks. We'll see you later.
Okay.